I'm Jack Bogle, founder of Vanguard, all those years ago. And I'm very pleased to have had yet another article published by the Journal of Portfolio Management, this one called The Clash of the Cultures. And by that I mean the triumph, really, in this day and age, of a culture of speculation overwhelming a culture of investment. There's no question in our financial markets that we need both speculation and investment. But as I say in the article, speculation has become the leading player in the film, and investment has merely a cameo role, and that's not the way the system should work. To give you some idea of the dimension of speculation versus investment, we have about $30 trillion traded every year in the securities markets, one investor exchanging shares with another, creating no extra value and, in fact, reducing value by the amount of the transaction costs involved. A stock doesn't know whether you own it or not, and in fact doesn't care. On the other hand, in terms of investment, or what we call, or like to call, capital formation, that's a number that over the years has totaled about $150 billion. The new offerings of securities, secondary offerings of securities. So if we compare the 150 billion with the 30 trillion, we're doing 200 times the amount of speculation as we are investment. That's pretty dramatic, and I think shows a financial system that is off the rails quite a bit. It's interesting to note that I first used the title Clash of the Cultures as a little subparagraph in my first book called John Bogle on Investing. That was back in 1993, almost 20 years ago. And I thought the problem was bad then, but it's gotten so much worse. And each year we seem to get a little more speculation and a little less investment. And it's not good for the markets. It's not good for investors. And what struck my attention as I started to think about these issues was how much this article brings to bear all the things I've been talking about and being concerned about for the last 25 or so years of my career. And that is trying to give the investor a fair shake, having portfolio managers, particularly mutual fund portfolio managers, exercise their fiduciary duty, the implications of short-term trading on corporate governance, because we all know that people that rent stocks aren't going to pay much attention to corporate governance issues, while people that own stocks are going to pay a great deal and must pay a great deal of attention to corporate governance issues. It doesn't matter much in the short run how a corporation is governed, but in the long run it means everything. And what we're trying to do in our society, or our goal in our society, should be to make sure that corporations are run in the interest of their owners. And the problem is there aren't many owners left. Too many speculators, too many stock renters, and not enough investors as stock owners. So all these things come together in today's trading markets, where with all this most recently high-frequency trading, where the turnover volumes are enormous. There's one of these traders whose average holding period, as I understand it, is 15 seconds for holding stock. So this trading activity has just overwhelmed the normal functioning of capital formation in our financial markets, and that's not good for any of us. It particularly lets corporate managers ignore the interests of their owners if they wish to, because there are so few owners that remain. So we have another part of this, and a subject I've been interested in for many, many years, and a subject which remarkably has gotten extremely little attention, is the change from a society, let's call it an ownership society, to an agency society. And when I came into this business, as financial institutions, agents if you will, owned about 8% of all stocks. And today they own 70%, believe that or not, of all stocks. And it's an issue that has profound societal implications that's almost always ignored by just about everybody. So I wanted to bring that to light in this article. Because when we have an agency society, the one thing we know about that, as Adam Smith said, you know, people who are agents for other people don't manage the money the way they would manage their own. They're more inclined to speculate. They're more inclined to look to their own interests if they're agents as compared to if they were running their own money. No investment manager worth his salt is going to be turning over his portfolio 100% a year like the average mutual fund does. So we have a long way to go to get these things fixed. There are a couple of solutions to it that I discuss in the article. One is what I call the Adam Smith solution, if you will, the invisible hand. If all of our investors in the U.S., individual investors, would simply vote in their own financial interests and move money to where it's run as an investment matter and not as a speculative matter, that people that speculated would eventually go out of business or change their strategies. It's going to take a long time for that to happen, I'm afraid, given our markets today. So what I'm looking to do is try and get people interested in creating a fiduciary society, a society in which money managers are required to put the interests of their shareholders first, are required to exercise due diligence in the securities they select, are required to be active voters in the shares of the corporation they hold in their portfolios, taking the rights and responsibilities of corporate governance into their own hands. And we would also have to have a situation in which conflicts of interest in money management would be eliminated. And that was going to be a hard thing to do, because so many of our institutional money managers are in fact owned themselves by corporations. Oh, amazingly enough, often the corporations that are held in their own portfolios, and so they don't do what is right to do, because they have to look at, I use the phrase, no man can serve two masters, and that is the money manager today has to serve his master, being the institution that owns the firm, who's in there to make a profit for itself, earn a return on its capital, if you will, as compared to the shareholders or the mutual fund shareholders or pension beneficiaries, and earn a return on their capital. And since cost is so important to this, the shareholder obviously wants the minimum cost, the institution obviously wants the maximum cost, so to maximize its profitability. And so we have a definite conflict of interest that I think we're going to have to eliminate legally, place a restriction on that, and that would come under my idea of a fiduciary society or a federal standard of fiduciary duty. Again, very hard to do. So I work at it day by day, trying to get the mission out and trying to get people to think about it and to talk about it and to recognize the chinks in its armor, the armor of our financial system, which are pretty frequent today, and see if we can't build something much better for our society and for the investors that finally are the providers of capital to all the corporations in the U.S. through our financial markets.